December quarter earnings for housing finance companies haven't been particularly robust, but Indiabulls Housing Finance beat the street estimates. Profits witnessed a jump of 55%. Asset quality remained stable for the housing finance player as well. What have been the other factors at play, and what does the road ahead look like for the company? Let's ask the management that. Joining us now is the Deputy Managing Director, Ashwini, Kumar, Hooda. Mr. Hooda, thanks so much for taking the time out and joining in. Now, I just want to understand. Good morning. This is Neeraj here. I just want to understand what the picture is looking like when we speak to a clutch of mid-sized housing finance players who may be offering loans in the low-income to middle-income housing segment. Almost all of them seem to be suggesting that there are some pressure points. For some of them, the pressure points are very high, and I have you come out with a number wherein your gross NPAs have dropped to the lowest levels in the last 21 quarters.
So what differentiates perhaps us with some of these smaller players is that we operate in average ticket size of 2.4 million, 24 lakh rupee segment, where we are largely catering to a white collar worker whose household income is on average a million rupees, 10 lakh rupees, and it is a very stable credit that we are lending to. Most of asset quality pressures we've seen is on lower ticket size. There was an RBI report on affordable housing where loans below 2 lakh rupees have more than 10% NPA, and between 2 and 5 lakh they have around 5% NPA, and between 5 and 10 they have 2% NPA. But surprisingly, loans between 10 lakhs and 25 lakhs, the NPA have dropped from 0.7% to 0.6%. So we are largely beneficiary of this segment, which is white collar entry level house being bought, where the house value is between 20 lakh to 50 lakh and a loan being taken from 15 lakh to 35 lakh rupees. We are largely present in this segment, and we are not at all present in a lower ticket size or lower income category. And here there has been a structural improvement in credit quality over many years, past almost 15 years now, where every year the credit quality actually shows a marginal improvement because there is more disposable income. The income stream is very stable, and the affordability of a house today a person buys on average is 2.7 times his annual income. So in last 2 years it would have been more like 3 times his annual income. At that affordability, the disposable income is huge. The credit performance of the portfolios are very stable. So we are big beneficiary of these trends. And as per capita GDP keeps improving, as more and more disposable income and affordability remains high, we believe the portfolio of this prime home loan on average ticket size of 24-25 lakh rupees, which are top 4-5 players in that range, the credit quality will keep improving as we go along.
You will, for the sake of incremental growth, will not go down the low income or the affordable housing pocket, which could be sub 15 lakhs or sub 10 lakhs as the case may be?
So the way a company looks at this opportunity is more on technology platform and not necessarily going ticket wise. We see ourselves going to around 70-80 more new cities. Based on our technology platform. We have India's first e-home loan product, entirely internet based, or digitizing customers' records and sending for central processing. So on strength of that, we will go to tier 3 and tier 4 cities. We've already opened these 70-80 offices, and we believe that we are able to go to these cities on a 3 to 4 year advance basis. We would have gone there much later. Because of technology platform, the cost of going to these new cities is lower, but there also we target operate on average ticket size of around 15 to 20 lakh rupees. So we are not really going down the ticket size curve as we speak. In future, of course, company keep evaluating that also as an area. But so far, we have tried to increase our distribution, go to tier 3, tier 4 cities where growth is humongous. More and more people are getting eligibility. Government pay packages have been revised post 7th pay commission and now HRA. So there is more disposable income hand of government employees and otherwise small and mid businesses employees. And we would rather go there right now than going down the ticket size.
Okay. So what do you think 2018 holds in store? Firstly, from the disbursements perspective, the loan growth perspective, and if you want to keep up pace at the kind of numbers that you've shown in Q3, and if I'm taking that as a benchmark, will you still be able to maintain the asset quality parameters, give or take a few percentage points here and there, or a few basis points here and there?
So the way we look ourselves growing over next 1 to 2 years is to grow at a pace of between 25 and 30%. The affordable housing push has resulted in huge volume growth in that segment. That segment per se also was growing very well even before the subsidy scheme of Prime Minister came in. In 2000 and FY17, before the scheme came into picture, the loan up to 25 lakhs grew by 33% and constituted 76% of all loan disbursement as per NHB data. So clearly this entry level house where a person is taking 24 lakh rupee loan is growing very well, and basis that we believe we can easily grow 25 to 35% on our book growth basis. We can grow our profits in 20% plus basis, and while doing this growth, our selectivity rates have not gone up. So we continue to do only 70% of salaried cases that we receive, or 35% of our self-employed loans that we receive. Keeping this tight selectivity rate, our credit quality, we are hopeful should be maintained where we are. It is unlikely to see much change from where we are today.
Okay, just one question. So let's say I heard you say that you are hopeful that the credit quality will be maintained. I think a clutch of other names which are now facing those asset quality pressures were hopeful that it will not change, but it changed quite dramatically. In your case, is it safe to assume that even if there could be a change, it won't be a dramatic drawdown from where it is right now?
So, we've been doing this home loan business for 9 years, and we have seen structural improvement in credit quality. I've been in mortgage industry doing retail business for last 18 years. Why I say that we are very hopeful, and this hope is not just hope, we are rationally projecting that the credit quality will keep improving based on, as I earlier also said, affordability is at all-time peak. The wage inflation has been steady at 10% for now more than 10 years. Property prices are stable. So all this is leaving more income in hand of a borrower, and as a result his credit performance is much better every year going forward. So on base of this long-term structural trend, I believe the delinquencies in this prime home loan business, which is 2.5 million. So this 25 lakh average ticket size, I can stick my neck out and say the asset quality 2-3 years down will be better from where we are today.
Now, one question that is coming up in almost all market conversations, Mr. Hooda, is the rising yields and therefore the probable rise in borrowing costs or probable rise in costs for almost all of the NBFCs. Now, I know that you've got this CRISIL upgrade, which probably helps you improve your cost of funds meaningfully. Over a 2-year period, with an assumption that we are in a space wherein rates won't come down, if at all, they will go up. Will you still be very competitively placed, or do you believe NBFCs by and large will have challenges which they haven't faced in the last maybe 3 or 4 odd years?
So, from a macro environment for non-banks, I would say those non-banks which have financed them in a ALM match structures and have not borrowed short-term to lend long-term would see only marginal pressures. The biggest pressure will come on those non-banks who have been resorting to borrowing from commercial paper market and which is cheaper than long-term funds. As a result, they will see the maximum impact. From a housing finance company like ours, which has a perfectly matched ALM, we do not see extraordinary pressure apart from the fact that interest rates have gone up, and to that extent they have to be either passed through or absorbed. The way we are seeing our case, because of, you mentioned CRISIL and ICRA upgrade, our bond prices have spreads have compressed by 60 basis point. So as a result, my incremental cost of fund, even in this increased rate environment, is lower than my back book, and I will continue to see my overall cost coming down even in next few quarters. Also, I have these 30,000 crore of bonds that are borrowed in AA plus structures, which will come for refinance over next 2 years, which will get converted to a AAA rated price, and hence I will have unique savings in the system. Having said that, I am not in the camp who believe interest rate can just go and shoot from here. I think we are largely done. I base my this assumption on the fact that the big joker in the pack was oil. Oil clearly showing signs of consolidation, and US production, we knew it takes 3 to 6 months lag, but at $55 liter, the $55 a barrel, US producers make obscene profit. So as a result, it is not going to sustain very high. Second, structurally the inflation, in absence of capex, in absence of huge growth drivers ahead, I don't think so inflation will shoot beyond the corridor of 4% plus minus 2% of RBI in any near term future. So there is a limited interest rate increase potential that I see going forward. We have already seen 50 to 60 basis point hike in interest rate in last 2 months, and interest rates hopefully will stay around these levels, and there might be a small interest cost which needs to be transmitted to borrowers, but it will not really impact any affordability measure or any kind of a credit matrix to have any consequence for housing finance companies.